Welcome to Iron Financial. This is the explainer where we do the heavy lifting to help you forge a much stronger portfolio and absolutely cut right through all the market weakness. I'm your lead analyst, and today we are tearing straight into the first quarter 2026 financials of United Parcel Service, or as we all know it, UPS. Okay, let's just dive right into this blueprint, because right out of the gate today, we have a massive disconnect that we need to talk about. UPS comes out, the bell rings, and they print an adjusted earnings per share of $1.07. Now, mathematically, that officially beats Wall Street's expectations. The street consensus was sitting around $1.02. So on paper, they beat the bottom line. Fantastic, right? But then what actually happens? The stock still slips in pre-market trading, bleeding out about 2%. And I know the market skeptics out there are already screaming at their monitors, asking if this is just an overreaction or if we are collectively ignoring some very serious structural damage here. So that leads us to the ultimate question. Why on earth does a stock drop on an earnings beat? Look, you've got a global logistics powerhouse here that literally moves roughly 6% of the entire US GDP. 6%! And yet, the market is trading it today like there are massive fundamental cracks right in its foundation. Listen, in the financial construction business, you have to look past the fresh coat of paint. That headline EPS beat? That's just the fresh paint. We need to inspect the underlying load-bearing walls. The smart money doesn't just sell off a beat unless they see a real storm on the horizon. The market right now is looking hard at the revenue quality, the forward guidance, and the sheer, staggering cost of keeping this massive corporate machine running. I know you skeptics want to know if this is just the standard settling of a massive building or if the foundation is actually giving way. Because when the company that delivers a massive chunk of our entire economy starts showing weakness, it isn't just a UPS problem. It's a macroeconomic red flag for all of us. To really understand the blueprint, we have to start with the sheer scale of this operation. Look at this number, $21.2 billion. That is the consolidated revenue figure UPS pulled in for the first quarter of 2026. Just to put that into perspective for a second, that is literally the size of the gross domestic product of a small country. And they generated that in just 90 days of moving cardboard boxes around the globe. But here's the critical part for our Iron Financial thesis today. That $21.2 billion top line, it's actually down. It's a 1.4% decline year over year compared to the $21.54 billion they printed in Q1 of 2025. And here's why that matters so much. A building this heavy simply cannot afford to lose its structural support. If you're bringing in less cash at the top, but your fixed costs, think about the massive fleets of trucks, the cargo planes, the gigantic regional distribution centers. If all of those stay the same, your profit margins are going to get absolutely crushed under the weights. To find out exactly where that pressure is coming from, we're moving to Section 1, Inspecting the Foundation, focusing on the U.S. domestic pressures. Let's not sugarcoat the reality on the ground floor right now. The U.S. consumer is exhausted, e-commerce has normalized incredibly aggressively after that wild pandemic boom, and we've got competitors fighting tooth and nail for every single package on the porch. If the U.S. domestic foundation cracks, the entire UPS portfolio is at risk of caving right in. So let's look at the cold hard numbers, because they tell a pretty brutal story of year-over-year bleeding. We already talked about the consolidated revenue slipping to that $21.2 billion mark, but I want you to look right at the adjusted EPS. It literally collapsed from $1.49 in Q1 2025 straight down to $1.07 this quarter. That is a massive hit to profitability. But the real structural damage? Check out that bottom row. The U.S. domestic adjusted operating margin. It plummeted from 7% down to 4%. That is a full 300 basis point drop. Think about that for a second. A 4% margin? For a logistics giant of this size, that is razor thin. If you sneeze wrong on a 4% margin, if diesel prices tick up unexpectedly or labor negotiations stall out, you are suddenly operating at a loss. The way this margin compression actually happened is a fascinating tale of two very different metrics. On one side of the ledger, U.S. average daily volume plummeted by 8%. That means millions of fewer packages are moving through the domestic system every single day. The trucks are quite literally running lighter on their routes. But on the exact opposite side, revenue per piece actually grew by 6.5%. So what does that mean? It means UPS is actively charging more money for the specific packages they do still carry. Now I can hear the market skeptics out there right now saying, wait a minute, they're just masking the bleeding with pricing power. And honestly, that is an incredibly dangerous game to play long term. You cannot just hike prices forever to offset a shrinking customer base. At some point, the math catches up with you. Shippers are going to balk, and they'll start moving to cheaper alternatives, like the Postal Service or regional carriers. A 6.5% bump in price simply does not mathematically fix an 8% hole in your daily volume forever. Management is making a highly calculated strategic shift here, but it absolutely comes with a heavy toll. When we look straight at the earnings release data for the segment breakdown, total U.S. domestic revenue fell 2.3% to $14.12 billion. And resulting from that, the operating profit dropped to just $515 million on a GAAP basis, or $565 million adjusted. Look, when your volume drops a massive 8%, but your revenue only drops 2.3%, it actually proves that your pricing power is somewhat working. They are successfully squeezing more juice out of every single box, but it's clearly not enough to stop the margin from collapsing overall. It's exactly like applying a tourniquet. Sure, it might stop you from bleeding out immediately on the operating table, but it absolutely does not fix the broken bone. The domestic house is practically on fire. So if U.S. operations are performing this poorly, how on earth did they manage to beat overall earnings estimates? That brings us directly to Section 2. The steel beams. We are talking about the international and supply chain segments. If the U.S. domestic segment is a crumbling foundation right now, the international and supply chain segments are the high-grade steel beams keeping this entire roof from caving in. Management has aggressively pivoted to lean on these operations. Now, I know what you're thinking. Global macro headwinds are fierce right now. We've got sticky inflation across the board, serious geopolitical tension in the Red Sea disrupting shipping lanes, and super volatile oil prices. So how strong can these beams really be? Well, take a look at this chart. This right here is the very definition of heavy lifting. While the U.S. domestic margin is sitting at that incredibly weak 4%, the international segment generated a massive 12.1% adjusted operating margin. Honestly, that is an absolute masterclass in maintaining structural integrity under extreme pressure. International revenue actually increased 3.8% to $4.54 billion. And the catalyst for that? A staggering 10.7% surge in international revenue per piece. But again, keep your skeptic hat on. Pricing power is a finite resource globally, too. Let's move over and check the data table for the supply chain solutions segment. This is their custom third-party logistics and cold chain business. Revenue here actually dipped 6.5% to $2.53 billion, primarily driven by some real weakness in the mail innovations business. But I want you to look really closely at the operating profit. It absolutely exploded. Adjusted operating profit surged from $98 million in Q1 2025 all the way up to $206 million in Q1 2026. Wait, revenue went down 6.5%, but their profit more than doubled? That is wild. That means management took a massive chainsaw to their internal expenses. They doubled the margin from 3.6% to 8.1% in 12 months on lower overall sales. That is pure, ruthless efficiency at work. But you can only cut costs so far before you start cutting into the actual muscle of the business. Which leads us perfectly into Section 3, heavy lifting, the $3 billion blueprint. Whenever you hear a corporate executive use the term transformation strategy, that is usually just Wall Street code for we are bleeding cash and need to fire thousands of people to artificially save our stock price. We have all seen this movie 100 times. A CEO promises billions in cost savings, but the actual execution usually disrupts their core operations, it angers the customers, and it totally tanks employee morale. But management here isn't just patching tiny cracks, they are aggressively stripping the entire house down to the studs. And the hammer is falling to the tune of $3 billion. That is the massive, non-negotiable target for full year 2026 cost savings from their network reconfiguration initiative. And they aren't just making empty forward-looking promises here either. They are already putting really heavy points on the board. In the first quarter alone, UPS hammered out $600 million in program cost savings. $600 million stripped out in just 90 days. That level of savings requires a brutal level of corporate austerity. But frankly, with a 4% domestic margin, they have absolutely no choice. They have to right-size this business immediately before the floor drops out entirely. So what are they actually cutting? They are cutting incredibly deep into both their physical and human infrastructure. Through their fit-to-serve and network reconfiguration initiatives, they are completely reimagining their network efficiency. Remember, they already completed a historic 48,000 workforce reduction, primarily aimed at management roles, back in 2025. Now, they are pushing even further with physical facility closures. They actually closed daily operations at 93 leased and owned buildings last year alone. They are rapidly automating sorts and consolidating the entire end-to-end U.S. ground network to match this new lower volume reality. Firing 48,000 people and shutting down nearly 100 facilities is a massive structural contraction. They are literally shrinking the company to grow the margin. That makes total sense on a spreadsheet, but you have to wonder at what point do these cuts start to degrade their actual delivery service.
That is the incredibly tightrope management is walking right now. And remodeling a skyscraper while thousands of people are still working inside of it comes with a very steep upfront cost. Just to execute these targeted layoffs and facility closures, UPS took a $42 million after-tax transformation charge in Q1. That directly hit their bottom line by 5 cents per diluted share. You literally have to spend money to save money in this game. For the full year, they expect these transformation costs to total somewhere between $1.3 and $1.5 billion. So they are taking a $1.5 billion wrecking ball to their own balance sheet this year just to generate that $3 billion in future savings. It's a necessary evil, but it makes the current financial layout look incredibly messy, and the market completely hates messy transitions.
So let's look forward and put it all together in Section 4, the verdict on structural integrity.
It's time for the final iron financial verdict. We've inspected the crumbling domestic foundation, we've tested those highly profitable international steel beams, and we've reviewed the $3 billion remodeling blueprint. Now, we need to deliver a no-nonsense assessment on the structural integrity of the UPS portfolio, based entirely on their forward guidance. No more looking in the rearview mirror at Q1. Here is the reaffirmed 2026 outlook. Management is not backing down one single inch. They are targeting $89.7 billion in consolidated revenue and an expansion back to a 9.6% adjusted operating margin for the full year. They're still pouring $3 billion into capital expenditures to modernize the network, and crucially for all you income investors out there, they are strictly maintaining that massive $5.4 billion dividend payout. That dividend is the iron anchor keeping long-term investors from fleeing the ship entirely. But look at that margin target, 9.6% for the year, when they just printed a consolidated 6.2% in Q1. That projection is built on the wild assumption that their cost cuts stick perfectly. Wall Street is deeply split on whether this is built on solid ground or a house of cards. J. Bruce Chan over at Stifel absolutely nailed it when he called these optically weak first quarter 2026 results. Following the report, he lowered his price target from $116 down to $114, but critically, he maintained a buy rating. The overarching narrative from analysts at both Stifel and Susquehanna is that 2026 is entirely a transitional year. They are saying the recovery is heavily weighted to the back half of the year, relying on an expected operational step-up. Let's be real for a second. Optically weak is just an analyst's incredibly polite way of saying the numbers look absolutely terrible right now. And a back half weighted recovery, that is basically management saying, hey, trust us, it gets better later. But with rising oil prices and a shaky consumer, later is absolutely not guaranteed for anyone. So we have to cut through the noise. Is this an opportunity or a trap? Are we buying this weakness or avoiding a falling knife? Here is the final iron financial verdict. If you are looking strictly at the bleeding domestic volume and that razor-thin 4% U.S. margin, UPS looks like a classic value trap. The foundation has sustained real, tangible damage. However, if you look at those international steel beams pulling 12% margins and you have a ruthless management team executing a verified $3 billion cost-cutting blueprint, all while paying you a rock-solid dividend just to wait it out, then this is a strongly reinforced portfolio buying opportunity for the long-term investor. But make no mistake, you're buying into an active construction zone. You have to be willing to endure a very messy, volatile transition period. That is the risk you take to build Ironclad wealth. So what do you think? Is UPS a foundational buy right now, or are there simply too many cracks in the armor? Let us know and keep forging a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.